And my first real estate deal ever, this is way back in the dark ages, was a real estate developer who couldn't sell. And this was beachfront in Maui on the island of Hawaii. You know, it's the prime property. And the developer was so desperate to sell. I basically offered to just take him out. He financed it, seller financed it, and I paid him with a credit card. That was my first deal. And again, as you said earlier, then the problem with that is when you're successful, you think you're Donald Trump or something.
I know. You gotta believe your own BS. You gotta be careful of that.
Yeah, it went to my head and I started looking for all these deals. But what happened was I got greedy and I stopped analyzing them as close. The first deal was really tight on my analytics. Beachfront, Maui, all this crap. It's $18,000 to get my credit card for $2,000 down. I was in. I made $25 a month and I was Donald Trump. So exactly as Kenny says, the problem is in a boom market, you think you're smart. Everybody thinks they are. But when the market crashes, kind of the good news is I think people come to their senses. They smell the coffee and they're more willing to negotiate.
Yeah, and it depends. I laugh because there's still these young guys, like 10 years of guys, if you're in your mid-30s, you're in trouble. Like I'm telling you, because you're not going to listen to guys like us. And so you're just going to raise that next fund, buy that next deal. Your head is down and you think tomorrow's going to be better than last. And I'm telling you, there's no way with interest rates now in the 6s and 7s that you projected that a year ago. There's no flipping way. Interest rates are higher. Your labor costs are higher. Any renovation or construction costs are higher. Those are facts. There's no way that you beat the market in those three things. So I just laugh because I see they're putting new funds out and they're raising more money. And people are, you can believe whatever, you can put whatever you want on a business plan and raise money. As we know, Robert, that can happen.
When I was a kid, they said, don't trust anybody over 30. Now that I'm 75, I don't trust anybody under 30.
Yeah.
Because, they were raising the economy of buy the dip, the Fed's got your back, just keep buy, hold, pray, and all that stuff. And I see these younger guys on YouTube and all this, and we know a lot of them. They're just saying, don't worry, the market will bounce back, buy the dips and all this. And the reason, let me give it again, this economy is different. Again, interest rates are going up this time, prices are coming down, but unemployment is going up. And the key is always unemployment. Or as we said, your neighbor loses their job, it's a recession. If you lose your job, it's a depression. And so that's why if you're in trouble, I would hire an attorney to guide you out of the mess. Don't ruin your future by defaulting or all the other stuff. But there's going to be a lot more opportunity. So what else would you say to be a person, any person, young or old, depending on the situation? Are they caught with their pants down or are you just getting started? What are the opportunities?
I think if this is a 9-inning game, Robert, we're in the second or third inning. I really believe that. Next year, we'll be in 5 or 6. I still think we're going to have high inflation through the end of next year. I think the Fed's going to raise rates all year, not as aggressive, quarter point, half a point. And we've been here before. In 2007, the federal funds rate was 5.25. Right now, it's 4.25. So, you know what I mean? And that's right before the last crash. So you can see the federal funds rate got raised right before that. I was investing during that time, Ross and I, but the key was you can still buy today, by the way. It just needs a cash flow, period. So if you can pay 7% on something and you have cash flow, and then knock yourself out. The issue is people are banking on it being worth more and they're exiting without the fundamentals that you guys teach in your cash flow game. It all boils right down to that.
So definitely don't buy the dips. And this time it's different. And it really is different right now. So I feel for younger people right now because a lot of them can't afford a home because they're still living at home or whatever the case may be.
Yeah, they're also chasing these crypto, FTX is kind of the big thing in the market.
Right.
I don't know if you saw this week, they're going after these YouTube influencers. And there's a $110 million lawsuit that came out last week. They're going right after them. I mean, you just go take a look. I don't want to mention any names, but I've been watching this. And these are 30-year-old plus. They don't have the experience of a down market. And so we had FTX come to me to advertise on my channel. I said, no, I don't understand like how this works, because the asset, as we know, the asset pays the return, period. It always does. And so I'm like, where's the asset? Like, I don't understand. So anyway, so that's all happening now. So you just got to be careful on who you're taking your advice from and how experienced they are. And I think that's going to be the big story for 2023.
The other thing too is that people are going to lose their homes. They may have a mortgage on this. So in other words, a home owner is going to become a renter. We have a lot of what they call low income, affordable income housing for the working class person. And unfortunately for that person, the next stop is a street. So if they can't pay their rent on a low rent income property that Kenny and I own, then they're homeless. So what's happening now is the white collar guy, let's say they're 65 years old, they're losing their house, they're losing their pension, and they're going to be moving into a rental unit. Is that a market possibly or not?
Yeah, there's a couple things going on there. One, if you own a home and you bought it 2 years ago and you got a 3 or 4% mortgage, you're not listing it, because there's no way, you can't even buy the same home in the same neighborhood and mortgage payment is significantly higher. So there's a lot of people that are going to stay for a long period of time, and that's going to hurt the market. The other one is if somebody's trying to buy something, to your point, it's going to force them into rental because the mortgage payment is significantly higher. So they're going to have to turn to rental because, one, they got to come up with more money, and two, they have to have a higher mortgage payment, and wage growth is not kept up. So the people's wages have not kept up to the way the mortgage payments have jumped in $700, $1,000 a month more for the same kinds of houses. So that's pushing people into the rental housing. And the other side of that, we're already undersupplied. I mean, if you look at the numbers, the last 10 years have not really kept up from a construction side. Maybe in the last 3 or 4 years they have, but prior to that, they didn't. So we have a huge glut, a huge need for housing, but it costs a lot. The interest rate to build housing is a lot. The land costs are high still. So all this needs to correct. To your point, the asset bubble needs to deflate. And then once it deflates, then people will come in and start to do deals again.
So looking into what do you see in 2023? So right now, the Fed threatens everybody. And the Fed, by the way, is basically a fascist organization because it's a private institution managing a public property, the Federal Reserve Bank. That's a definite fascist. And that's why most people like Rand Paul and all that and the Fed and all this, because all they do is they make their friends richer. That's their job. So my concern in here is this: what do you see if they keep raising interest rates? Then eventually they're going to have to print more money for social costs, like homelessness and all the other things that the socialists, the equality guys love. Do you see the same thing? They're going to have to increase spending on the people who are losers caused by the Fed?
Yes, without a doubt. We're already seeing rent control. We're seeing rent caps. We're seeing policies passed. All kinds of cities and counties and states are discussing this. And so it's interesting. I was talking to the head of capital markets at a very big company, one of the guys that we use. And I said, where are you guys investing? Now, this is debt and equity at the highest level. He said, we're staying away from the coasts, except for Florida, and we're focusing on the inside. Basically, he said, why would you invest in Oregon when Oregon says we're going to cap your rent and we're going to bump and we're going to raise your property taxes? And so the financial markets are really taking note of these political decision-making, and I'm not trying to be political here. I'm just saying that if you're going to, money goes where it's treated best. And so if you're not going to invest in St. Paul, Minnesota, because they put a 3% rent cap on there, even though, by the way, it might be needed for the renter base, but the money is going to stop flowing there and it's going to move somewhere else. And so that's what's happening now.
Would you explain what rent control is and all that?
Sure. So a state basically controls how much you can raise your rent, and that's it. So if you're a landlord, they can cap your increases.